This meeting is being recorded.
Welcome to the Think Realty webinar series. My name is Rodney. I am the Director of Sales here at Think Realty. We are so glad you joined us again today. We are excited because we're going to talk about investing in the wonderful state of Florida. Just a reminder, we have the Think Realty Conference coming up on July 21st and 22nd, right there in sunny Tampa, Florida. So you don't want to miss it. There's going to be a huge amount of our speakers there. That's really going to just engage and talk about what's going on in our industry. So you don't want to miss it. This is recorded, so I will send out the recording to everybody. And when I do, I'll send you out a special code to get you a discount on the tickets to come to the event. So today, Romney Navarro is going to be moderating our panel. So at this point, I'll just turn it over to Romney. Romney, welcome to the show.
Thanks, Rod. Appreciate it, man. Appreciate you having me on. Also really looking forward to the Tampa event. We, as a company, are going to be moving into the Tampa area here heavily. We're already dabbling now. It's time to move heavily. Timing is really interesting, but I'm excited to be a part of the Think Realty fam and world again. So, guys, we're on a panel. A virtual panel. It's definitely a little different than a more traditional panel. So it should be interesting to see how the technical part plays out. But we're talking about investing in Florida. I think everybody here has some expertise. Panel, I was jotting down some notes and I was thinking, should we stay very evergreen, very high level? Should we stay very like what we knew, or should we talk about what's going on right now? And I couldn't help but think it's the time is right to talk about what's going on right now, because what we've come to know the last few years. Totally different now. And that's just kind of creating a different landscape. So it's going to be fun. I did real estate loans. So a single family home to a multi-family home. That's what we do. Sounds like we've got a bad connection, so I'm going to mess around here a little bit. But with that said, let's jump in and maybe do a quick introduction. I'm going to go in order of the screen. Gary, if you don't mind, maybe take.
Sure, Rodney, and maybe just
that's the way it goes, I guess.
maybe stop share the camera and see
or don't really know what we can do. Gary, can you hear me?
I can. I stepped on you like 3 times. Just maybe try stop sharing your camera and see if that'll help with us. So I think you said introduce myself. So I'm Gary Pinkerton. I'm normally in Sarasota, Florida, and I moved there about 2 years ago from up in the New Jersey area for about 10 years. Going back a little bit further, I'm wearing my my background or my history of being in the Navy for 30 years. Grew up in Southern Illinois. Been investing in real estate for about 10 to 12 years. Focusing now primarily on the state of Florida, but definitely in the South, in places where it's landlord friendly, where we see a huge in-migration over the last 2 or 3 years. I'm most bullish on Florida, but I'll take something in Texas too if it makes sense. But so I'm focusing very heavily in the Cape Coral, Florida area, and I have several long-term properties that I've owned up in the Jacksonville, St. Augustine area. My day job is helping people implement infinite banking as a more efficient way to fund their real estate. But I'll keep focused on my experience as a kind of an end user, as far as somebody who's running real estate properties, both from a long-term and short-term rental perspective. Thanks, Romney.
Thanks, man. So I hope the taking off the video did help a little bit. Let's go up to John if possible. John, maybe a quick intro. We'll start keep it moving.
Yeah. Hi, Romney. Thanks for the introduction. My name's John Cade. I'm a field market specialist with Finance of America Commercial. We specialize in short-term financing for fix and flip bridge and new construction, as well as permanent financing for rental properties. All of our products do not require personal income verification, and LLC title is allowed. So I look forward to speaking with everybody today.
Great, keeping it going. Dustin, if you could say a few words.
Sure. My name is Dustin Lauer. I've been in Florida for about 17 years and was also born here, but came back right away as soon as I could. And been lending since 2009 in this great state. So hopefully can contribute a little bit to today's discussion, and very appreciative of being on. Thanks, guys.
Awesome. So we got a couple lenders, Infinite Banker, and last but certainly not least, Robert Knight. Maybe you could let everybody know what you're up to and what we're going to be talking about.
Absolutely. Yeah, I'm Robert Knight, and with Whitestone Developments in Cape Coral, Florida. And we're an investor-focused builder in the area. So we're providing turnkey build-to-rent solutions for investors from all around the country. We're building around 140 single-family homes right now. We do multifamily as well. We've got a couple resorts that we're in the process right now of permitting that are going to be fourplex communities for investors. So instead of getting your kind of independent fourplex that doesn't have any amenities, kind of, you know, left alone, we're creating all those fantastic amenities with the resort style swimming pools and fitness club and clubhouse and all those kind of things, and then creating fourplexes within those communities and renting those out here. And we're super excited about the build to rent opportunities that we have here in Cape Coral. We feel like we live in paradise, and looking forward to contributing in any way we can here on the panel.
Awesome, man. Well, I'll tell you what, guys, we were talking about it a little bit via email prior to the event. And I was saying, you know, our customers, and I think I'm speaking about all of our customers are all entrepreneurs. In my world, they're builders. In Gary's world, I suppose, you know, anybody could technically be a customer, an investor, a retiree, whatever the case may be, you know, investors, so on and so forth. That's who our customers are. They're entrepreneurs, and they're seeing kind of an economic climate change. The words are getting a little stronger. Used to be inflation, and it was interest rate. Now it's recession. What are these words get a little bit bigger and stronger every single day. But these guys are entrepreneurs. They're going to ride into the fire. They're going to do everything they can to see this whole thing through and actually prosper in more uncertain times. So I guess since we're talking about real estate investing in Florida, let's talk about that a little bit. How do we know, guys, just in general, you know, how do we know if Florida is insulated, or how insulated Florida may be from this kind of economic uncertainty? Rob, I think we should start with you because, you know, you're on the ground.
Yeah, in terms of insulated, you know, when I look at all the different areas around the country, I see this whole net migration that's going on between red states and blue states. And we've seen them. They used to say there was 1,000 people moving into Florida every single day. Some people are saying it's up to 5,000 people a day right now. So I don't know what the actual numbers are, but I do know that there's a massive amount of people moving into the area. And I think that when you're often investing in an area, if you've got that migration trend behind you, you certainly have got an insulation from some of the other things that are happening. And real estate obviously is regional. And when the area you're sitting in has so many people really wanting to move into the area, certainly that's going to give you an additional insurance as you're investing and walking through, whether it's high inflation or whether we're into recession. You want to know that there's a lot of people still moving into the area for sure.
Yeah.
Go ahead. Yeah, I think for me, some of the things that Lost you there for a second, Romney.
I think you just said, go ahead, just finish.
Oh
your
yeah,
thought.
okay. Sorry about that. So yeah, so for me, I look at number one, our state, we're very investor friendly. We're landlord friendly. We're over $1 trillion in terms of GDP in the economy. We're really keeping the budget super tight. Our governor's done a fantastic job just cutting expenses. He's actually, looking at the potential of recession coming, and I think he's making a number of moves in that whole kind of cost cutting even right now, so that we're going to be able to ride out any kind of recession we have a whole lot better than if we were just spending like crazy like some of the states are.
Yeah, I mean, at its core, real estate, but generally speaking, any market, they're all driven by the same thing, that is supply and demand. So what you're saying is we got plenty of demand. That should hold us over maybe differently than somebody else. I think that's what I kind of interpreted from what you said. And I tend to agree. I mean, it's a lot of things. It's interesting. It's a little bit, sometimes even perceived as challenging to throw in the red and blue state, but it's absolutely a migration to red states right now. And it's, we do a lot of business in Texas. We do business in Florida. We do business in Georgia. We have similar thoughts on the economy in terms of supply and demand, mostly or largely as a result of that, because people are moving there. People are moving away from the Californias and the New Yorks of the world. Guys, what are you seeing as it relates to, how Florida is or isn't insulated? Maybe some additional color or commentary from the uncertainty. I think John's unmuted, so I'm going to start with you, John.
Yeah, no problem. Back to the Florida demand. And, we really saw it coming out of COVID with a lot of investors feeling that the Florida market was still undervalued comparatively in other parts of the country. And there's a lot of investors that have been buying up real estate here over the last year or so, with the anticipation that values are going to continue to go up and rents are going to continue to go up. Well, as long as we have this shortage in supply and this strong demand, I think those trends are going to continue. We've seen a big shift in investors pulling as much cash out of their rental properties as they could and deploying that and buying real estate in Florida. So it's not just, they're buying turnkey properties because they want to be landlords, and other investors are still trying to find some distressed property that they can purchase and rehab. And then they're not flipping it. They're holding it as rentals. So it's a buy, fix, and hold mentality. As prior to COVID, it was the opposite. Everybody was flipping everything and selling it for a profit. Now it's like, you know what? I think I can hang on to this asset, appreciate it over the next couple of years, continue to raise rents, and it's a solid investment. So, I'm of the mindset, I've lived in Tampa for 18 years. I've seen a lot during that time period, ups and downs. But I think it's a real strong market to invest in going forward.
Yeah, I tend to agree with you, and I'm curious what everybody else is thinking. Dustin, if you don't mind, maybe chime in a little bit on that. What's the street telling you?
Yeah, I'll say that one thing that a lot of publications online are talking about what percentage of the economy is working remote, and not that all of Florida is going to be isolated. More gateway market like Miami may have price decreases and things like that. Especially as we're looking at data right now coming out from House Canary and Florida Realtors that suggesting some depreciation and some price decreases in certain markets, and especially certain inventory type like condos and townhomes. But I think that with LinkedIn publicizing that, roughly 25% of the market's going to be working remote, in 2023 and continuing this year for, roughly about how many people work remote or at least hybrid. That makes a lot of markets like, Southwest Florida, where you don't have bad traffic and the prices, kind of compete with Midwest and certainly are better than Northeast or California price points, and taxes are better than Texas for property taxes, and insurance isn't too bad for the hurricanes on that side of the state. So you've got, definitely if you pick your battles and you're not too market specific. So I wouldn't say Florida as a whole is fully isolated from all the uncertainty and rate increases, but I would definitely say that certain markets have a great advantage with the amount of just net migration to the state, and the amount of people that are working from home don't have to be in a major city anymore. That's helping Florida a ton.
Yeah, thanks, man. It's funny. Part of the reason we're having some technical problems is I'm just and kind of mobile at the moment, and what I was hearing there was really interesting, and there was a lot of I heard a lot of optimism in some of those responses as compared to some of what I was hearing from people from other parts of the country. We were the space lenders from the Florida-based lenders weren't quite as optimistic. They were a general strategy that you'll see across the board for certain people. But as I mentioned in our email, kind of prepping for this, a lot of people are going to retreat and not do a lot of business right now. And I think the real estate investor, the entrepreneur, absolutely advances right now. So it kind of brings me up to the next guy, Gary. If you guys don't know Gary Pinkerton, he's a very opinionated man, and I mean that in the best possible way. In fact, so opinionated that I love it because it's all so freaking logical. So Gary, we're talking about the economy now. We've been talking about the economy for years, but today, where things stand, what are you seeing? And maybe comment, kind of spread the gospel a little bit because I know you can.
Yeah, so apologizing for my voice here today, but I just came back from a 10-day conference in Belize where Daniel DiMartino Booth and several other economists and real estate owners, investors, business owners were getting together to talk about the economy. And everyone at that conference certainly left, 250 people left, 100% confident that we're in a recession already. It probably started December 2021. The way in which the government works is that it takes 18 months worth of data, and about a year and a half from now, they'll tell us that it started 6 months ago. It's just the way it has to work, I guess. But we're in one. The question is that going to be the entire country or not? In my opinion, it never is. Like, you can't find in the Depression or in a recession an example where everyone went down, right? There's always, like, some of the largest blue chip companies are born out of depression and recession. So we're there. So how does that affect, Florida and real estate investors in general? And, I take it back to the basics in that, like, if you look at Rob Knight, he's running a construction business and a management kind of business. And then I'm on the other end, I'm an owner. And so we're kind of bookending this whole idea about long-term buy and hold real estate, right? And every business owner, even if it has nothing to do with real estate, needs a customer, they need a product that's in demand, and then they need an environment where they can do business, right? And so if he has a great product in California where they won't let him build it, it doesn't matter. Or if they do build it and I buy it and they won't let me operate it, meaning I can't fire people who won't pay me as a tenant, then it still doesn't matter, right? So I don't think the recession or anything coming in the near future is going to affect that here in Florida. And so I think the environment will support us doing business. And then it just comes down to, will there be demand, right? And clearly COVID pushed a huge demand down here for freedom, essentially, right? Like, people are allowed to actually, walk around and do and decide whether they're going to, do things that they want to or not do for their family. And I'll keep it family friendly and stop there. But, the bottom line is that the people voted with their feet. It's called agency. They had the ability to make their own financial decisions, and they moved. They didn't all come to Florida, but a lot of them did. And I think you're going to find that a lot of them are going to stay. So I think the demand is going to be there for the product. And then the question is just, is it overpriced? And how far will it come down? and it can certainly come down. But I just look at, like, for example, even Tampa, just up the river, or over in Miami, right? But if you really want to see something extravagant, you look at a blue state like California or New York City, right? And, you know, the bricks and sticks that you would have to pay Rob Knight to build something on that property is 1/10 of the price of what you're paid. If I get it wrong down in Cape Coral, Florida, and the land value just plummets, I've lost $50,000 to $100,000 depending on what lot it is, but I haven't lost $1 million plus, right? And that's the risk you take in cyclical places. Even, again, I'll even just point at Miami, even in here in Sarasota or up in Tampa. Like, you could lose, you know, $300,000, $400,000, $500,000 on land value underneath the asset. That's just not reasonable in Cape Coral right now. So places that are, you know, kind of underdeveloped like that, up and down the Southwest Florida coast, I think are very, very safe bet, and your downside protection is pretty good.
Thanks, man. I tell you what, I think it's permission to speak openly here, and I know you won't hold back, but I believe everybody, including the panelists, will be really interested in hearing how you, quote unquote, really feel. With that said, you said something that was really interesting there, and I've heard you say that in the past. You know, we've gotten to know each other a little bit more post-COVID, if that's what what the world's calling it, post-COVID. But what you said was people voted with their feet. That means they moved here to Florida. Why? Because they were leaving somewhere else for a better situation. So I'm wondering, are they going to continue to vote with their feet as as things get a little tighter in the New Yorks of the world, in the pick a state? Do you think this voting with their feet is going to continue?
I do, and it won't just be to Florida, but I think that trends like this take a long time to reverse, right? So why would a blue state start becoming more landlord friendly? Why would they become more like freedom minded, right? It's because a period of time has occurred where they weren't that direction, and it got bad enough that they realized that they need to attract people again and businesses again go back that way, right? Like, if you look, for example, in downtown New York City, that place got hollowed out, and it has not come back to where they wanted it to be because they still haven't changed the practice, right? So it takes a while. So I think that some people will move back north, right? But that's going to be decades. It's not in the short term. So, you know, it's not something that is risky in the short term. And personally, I don't know that Florida's population will ever actually go down. It may slow down on how fast it's increasing, but what we'll experience is that the overall population growth in America will mitigate, if not keep it going up the whole time. I don't see a hollowing out of Florida and everybody rushing back north, because I don't think that there's enough pressure right now on the northern states to reverse their approach, right? I mean, we're a long ways from them reversing. Even if, you know, the Republicans take over both sides of House, and in 2024 they take over the presidency, and everything is like, you know, unicorns as far as like freedom, I still think it'll take a long time, because you also have the weather. You have everybody's in-laws down here, right? And so, and the price of goods and stuff. So it's going to take a long time, if ever, that reverses.
Yeah, guys, Justin, maybe starting with you, but talking about what he just, talking about voting with their feet. Your business is a good indicator of how things are going. For the investor listening, whether it's a casual investor or the seasoned investor, some of the their business is also a pretty good indicator as to lending money on real estate. In your world, how has the business changed over the course of, say, the last 6 weeks, in your business?
Yeah, so I would just say one thing that we see kind of some clients doing that's, I think, ahead of the curve and going to pay off well for them is they're focused on slightly, if they're build to rent guys, they're focused on slightly smaller footprint single family, and they're doing more 2 to 4 unit, and that may be being flexible on where they're doing business. But I think they're focused on fundamentals, like what Gary mentioned, on going back to basics, and focus on cash flow. Those clients that are doing that, that's great on them. Other clients that we're seeing more success with are if they're builders, they're building for construction management fees, and they're offloading some of that balance sheet risk of building for their own account right now, because banking on appreciation or refinance in today's market isn't the smart thing to do. So I think just recently we've seen more smaller footprint deals, more unit count, and focus on cash flow, which I think is great. It's great to be focused on the fundamentals when there's uncertainty and rising rates.
That's great, man. So we've got a bunch of people moving here, and the investor is adjusting their philosophy a little bit, not staying away from the big stuff, kind of dropping down to a little bit of the smaller, more fundamental things, rentable type real estate versus the appreciation. I love that because we said a couple of things. We're talking about some data while we're not sharing stats necessarily just yet. We're talking about some data. There's a lot of net migration. There's people moving in, and we're sharing assigning strategy to that. That's happening. Yet the economy's changing. The houses aren't as affordable, both because of their price and because of the interest rates. So let's build a little smaller, a little bit more manageable that the investor could hold on to. And kind of weather the storm with. Let's talk about that for a second. I think it was Gary that was saying it. If not, it was Robert. I'm not sure. But the comment was made that inside of these types of economic cycles, opportunity arises, and on the other side of it, some of the giants are born, or I guess they're born within it, and they arise on the other side of it. Hey John, what is the opportunity as you see it right now, that's presenting itself? What is what type of firm, what type of individual will be very well off, kind of living through this market cycle, and what type of strategy will be well off living through this market cycle and then coming out the other side the winner?
Well, the main problem that we have right now is lack of supply. I really like the build to rent space right now, just putting more assets available for renters. Everybody wants to rent a brand new house. And we talked about, I'm in Tampa, but we talked about, Southwest Florida. There is so much land out there. I mean, south of Tampa, and very attractively priced. So, Port Charlotte, the Rotunda area, further east of the Gulf, you get very attractive lot valuations there. So I see a tremendous opportunity to go in there and buy inexpensive land and build affordable homes, and put those for rent for a long-term strategy.
Got it, man. It's a theme, build to rent. Robert started kind of his introduction saying he's building hundreds of units currently, including some multifamily, and some of that multifamily, Rob, correct me if I'm wrong, those are rentals, right? Those fourplexes, so on and so forth.
Mm-hmm. Yep.
So are you building those for investors currently, or are you building those for yourself?
It's going to be a mixture of both, for ourselves and for investors. And for me, when I look at Florida right now, I'm really optimistic for this market and this time right now, because everything we're doing, everything our investors are doing, we're all focused on cash flow. And I know whenever you buy for cash flow, you buy with good valuations. And I think, just like you've seen over in California, where some of the markets over there have just they just taken off. The only thing you have there is a play for appreciation. I think Florida eventually, as that net migration just continues, people continue to come in here, our cash flow is going to get compressed. So I actually think right now is a really good time for people to be locking in the cash flow in Florida while it's still available, because there's no guarantee as we move on in the future that we're still going to have those kind of cap rates that we have right now. So I think even though in the middle of all the uncertainty and things like that, right now is an excellent time while the cash flow is still available.
So yeah, I mean, I think it's a consensus with everybody on the call, and Gary, we didn't talk about it too much, but the consensus appears to be invest for cash flow, not invest for appreciation. It's almost a no-brainer at this stage in the cycle. Um, Gary, you mentioned you're investing in real estate around the state, but your background is that of infinite banking. It's something that it's not a household term, but it's powerful. How do real estate investors take advantage of infinite banking in general, but kind of with what we're facing at the moment?
Yeah. So before I go there, if I wanted to just bridge one thing between the lenders and between Rob as kind of an end user, and it is challenging right now to try to take advantage of some really good cash flow coming from short-term rental, because there's a lot of hesitation in a pending recession or in a recession for lenders to provide funding for something that's penciled out for short-term rental. So like if I went and wanted to build something in North Carolina on the shore or in California on the shore, it would be a couple $1 million, $3 or $4 million, and it wouldn't pencil out for anything but short-term rental, high month or high daily rates. But they're seeing that value could completely fall apart, and so it doesn't work out. But the beautiful thing about up and down the coast, both east and west side of South Florida, is that I can go through this whole process, assuming it's going to be a long-term buy and hold rental, and then turn around and try to do it short-term, right? And so if the economy if the recession ends up such that no one's taking vacations, because that is pretty discretionary, then I can just shift it over to a long-term, food, shelter, clothing type of an environment and still pay my rent on it. So that's a huge advantage that I have down here that I wouldn't be able to reproduce in other states. So as far as infinite banking, I mean, the easiest way to think about it is that all of us, as we're making investments and as we're kind of marching through life, we have a few things that are necessary, like a place where we can store our emergency money for our family, reserves for our business, reserves for our rental properties, right? So if I have 30, 40 doors, then I need to have, a few $1,000s for each door to cover roofs and HVAC and tenants not making payments and all that kind of stuff, right? Nothing like 2020 to teach a real estate investor and business owner when the mayor of every town they threw up a television, a TV crew, and they said, hey, listen, renters, we know you're hurting, but so you don't have to pay your rent for the future, right? And we all listened, but no one said that about the mortgages for the landlords, right? So it taught all of us, and it taught all the business owners who had their doors shut that, hey, you need to hold some cash on the side. So whether it's family emergency money, whether it's reserves for our businesses, or whether it's just down payment for that next investment, storing that money in a checking account where it's not earning anything is really, really expensive long term. And so instead of storing it to get ready for that next investment or holding it on the sideline here, getting ready for like after the recession when the deals are really good, my clients and I hold our money in high cash value whole life insurance, which grows at more like 4 to 5% with no tax, right? And yeah, it has death benefit, it has all these other benefits, but the bottom line is that it's a much better place to store and grow cash. So fundamentally, it's kind of home base for your money in between deals and a much better place to store all that reserve money that you have.
Yeah, one of the questions that I had teed up, guys, was where is the safe money going right now? And it seems like just fundamentally over the years and years and years that we've been not we, but the country and just society has been creating investment vehicles. It seems like insurance seems to be where the safe money always goes. It always ends up there and always kind of stays there. Where's the safe money going in real estate as right now? We've talked about we've talked about rentals, we've talked about smaller, we've talked about cash flow plays. Have you guys seen the traditional real estate investor who is buying a piece of real estate, putting a tenant in there, refinancing, or buying a piece of real estate, improving its value, selling it for profit? Have you seen them talk about potentially investing in, say, notes or debt as compared to the active kind of participation that they currently take, which is out of a flipper or landlord? I'm sorry, guys. John, I'll start with you.
No, I haven't seen that, but I know that was a very popular business after several years after the crash, when a lot of lenders put a lot of non-performing notes out in the market, and a lot of investors took advantage of that and purchased those non-performing notes and either foreclosed on the property, which was typical. That absolutely could come back. but I haven't seen it directly in this short period of time just yet.
You know, Dustin, I'll kind of ask you the same question, but I'll preface it by saying this. That question was a little bit pointed. It was a little bit more kind of what I'm seeing. So we, as a company, our company, Streamline Funding, we manage, we originate loans, we service those loans. Part of the servicing is we collect payments and distribute it to our investors. We are largely funded by way of private investors. And, you know, I remember in 2008, 9, and 10, very, very unique time to transact, but we were in business. Which is a good sign, by the way, for everybody listening. There's opportunity out there. We just got to find it collectively. But in 2008, 9, 10, kind of hard time to do business. 2010, 11, 12, we started kind of coming back up and things were starting to happen and bloom. And part of that bloom was people were saying, well, after what we just went through, the wreck, if you will, I want to invest in something stable and predictable. So they started investing in our notes, in our loans. They were getting first liens, you know, they were the lenders, they were the bank. Okay, no big deal. 2012 comes around, 13, 14, 15, 16. Now we start getting a little bit more aggressive. And some of these people that were looking for at the safe money, what I would call the quote unquote safe money, started venturing off into a little bit more active equity type investing. And what that means in the world of real estate is, you know, bigger down payments, becoming developers, buying a lot of real estate. They've done very well. But right now I'm starting to see a lot of people calling me back and saying, hey, what are your programs looking like for investors? So people are starting to park the cash a little bit. And by the way, guys, for everybody listening, all that I'm trying to say there is that there's always another way to do this. So right now I might have my investors earning 6, 7, 8, 9% returns in a fairly safe vehicle as compared to some of the things that they've been doing over the last 7 or 8 years. Dustin, what's your take on all of that?
So I think for retail investors, you know, not that it's a slow-moving ship on the institutional side, but I think now you could follow the institutions, right? Institutional investors are buying notes. I've seen a lot more retail, especially with a lot of tech that's popped up, you know, over the last few years, both on the fintech and the prop tech side. But like, you know, traditionally illiquid asset class like note investing, there's companies like PaperStack, Pure Street, AlphaFlow. You can go in there and like be like a partial investor in loans, whether you're doing borrower dependent or individual loans. There's lots of like, I think it's a great resource to reach out to a local lender if you're you know, in a market that has private lenders, which most of them do. And I think that's, you know, an opportunity for a retail investor to, you know, have good cash flow there, because institutions are largely financing that market space right now. But as credit becomes tight institutionally and less securitizations are issued, or you know, less loans trade to life cos and different investors institutionally, then, you know, the private money shines. And it's actually, ironically, when credit gets tighter, usually is when the deals get much safer for the private investors. People are willing to trade expensive for fast and reliable, and you end up with lower loan to value and better economics in those times. And then you obviously just following the institutions into the build for rent space that we're, you know, saying as a recurring theme here on the webinar, that, you know, that's a great space for you know, retail capital.
Yeah. So not necessarily the appreciation, more so the cash flow. Direct lending is one way to see some cash flow with some security. Obviously, build to rent. I'm very hot personally still on build to rent. Very hot personally on build to rent in those markets that are seeing, you know, inflows. Like we talked about John being in Tampa, Robert being in Cape Coral. You know, those markets have people moving in at any given time. I mean, they're just going to continue to move there. Where we do the majority of our business in Austin, Texas, people are still moving to Austin as a result of, you know, I mean, nothing else because of salary jobs. People make money in Austin, Texas. Therefore, people move here. So let's talk a little bit about the specific markets in the state of Florida. What is the this is a weird question and maybe a little bit of a challenger question, but what is the safest market in the state of Florida right now that if you're going to invest macro level, you're sitting on a little bit of a checkbook, where are you going to buy a piece of income producing real estate? Oh, sorry. Let's start with Robert. That's an easy layup.
Cape Coral, Florida. No. Yeah,
that was a dumb one. That's awesome.
I appreciate that, Romney. No, I think at the end of the day, it's following the cash flow again. Again, everywhere in Florida has the net migration behind it as a trend, but to follow the cash flow is the key.
Yeah, I'd agree with Rob that Cape Coral is solid. And again, for me, it's because the land price has not been escalated up and there's jobs there. Another great one is Jacksonville area, right? And Tampa area. So Tampa also has not appreciated too heavily. But I think when you get to like Orlando and Miami, and there's a lot going on there that is tourism, and that's at risk, in the short term, at least, for recession and those prices coming back down to where they already are in Cape Coral and Jacksonville area.
Yeah, I would say just going outside of the big MSAs, and two reasons for that. The valuations are more attractive for the acquisitions, and the renters are going that way too, because the rents are a little bit less. But that's okay for the investor because their acquisition cost is a lot less than in the big MSAs. So I think that trend is going to continue. Just don't buy in the hottest markets. Start looking, a 15, 25-minute drive outside of that market, and you're not rural, but you get better prices, and you're going to have more rental demand.
Guys, go ahead, Dustin. Go ahead.
I definitely would second what John said. To name a few for any listeners, I would say Orange City, Ocala, Port Charlotte, Palm Bay, Northport, and definitely Southwest Florida in general are strong. But the reason I picked those is median list price right now is like $460 in the state, and you really need to be maybe 2/3 of the median price point or lower. Not obviously the low end, but that's the part of the market that's safer. So just kind of keep in mind where the median sales price is at, median list price right now, being significantly below that, and then some of these like secondary, tertiary markets, I think would be my suggestion.
And there was it's funny. I was teeing up a question, Dustin, that you just answered. So thank you. No, it was perfect. It was perfect. I was actually going to look for what are the undervalued cities? Because I think everybody was kind of saying a couple of pockets, a couple of things, but using the term undervalued, what are the undervalued deals, the value plays right now? And I think you just mentioned a bunch of them. Are you guys following, or let me ask it maybe another way. What fundamental stats are you guys looking at on a daily, weekly, monthly basis right now to understand, where things are going? And I'll give you a little I'll put a little teaser in there. I'll tell you kind of what one of the things I'm looking at is business, just good old fashioned business. Which companies are moving where? I saw a deal recently where, a large tech firm recently, within weeks, announced the building of a new plant, and I don't remember exactly what it was that they're going to be producing, but they're going to be building some type of plant where it's going to bring in a couple thousand jobs. And I can't help but think, well, if they're going to bring a couple thousand jobs, that's going to require a lot of homes. Therefore, I want to point my guns there. So what stats or what things are you looking at to tell you if there's an opportunity, emerging right now? John, maybe starting with you.
As a lender, really, I lend in 47 states. So I'll pass on that because I'm not really drilling down on where to invest individually. I know I have investors investing all over the place, but I'm not looking at any specific stats like that. Okay,
no worries. Let's take it to Gary, because I know he is very stat driven, or data driven. What are the things? What are the indicators that are out there that exist that you're looking at? Maybe share some of that knowledge.
Yeah, so and I want to make sure that Rob gets some time because he shared an awesome article in Think Realty magazine that all the listeners should go back and pay attention to, that came from a conference that he was at down, I think it was in Fort Lauderdale, Rob, if that's right. But you know, it is, I'm looking at things like the U-Haul truck, you know, which directions are they going? And you know, I remember when we moved down here 2 years ago, I had to go 4 counties away to pick up my U-Haul trailer. And when I got down here, I had to go a county away just to find a place I could put it, because there were U-Haul trailers everywhere. And I was just thinking, like, if I had the time, I would have started a business to figure out how to, you know, do Uber U-Hauls back up to the north. So that's one that I pay a lot of attention to. And that just basically is just a backup to the migration statistics that are, you know, that are out there, because it's really the same thing. And then also, like you said, looking at just news for business changes. But for me, you know, it's really prices, you know, affordability of land. Because in the end, what I'm investing for and what a lot of buy and hold investors are out there doing is they realize that, you know, you want to be on the same side of the table as the Federal Reserve when it comes to printing money and devaluing the currency. And so you want to be somebody who is holding on to these long-term fixed rate debts. And people are all scared now about 5 or 6%. I'm good up into double digits. And I'm good up into double digits because the inflation is higher than that. And so I'm still getting paid to short the US dollar. And I'll have a conversation with somebody about that if they want to go into greater detail. But, you know, to me, the most valuable thing about buy and hold real estate is the mortgage. Like, what these guys provide is the value. Because I'm able to short the dollar, and I can't do that. I can't go buy gold, which I love also, and then have, you know, and get a 30-year fixed rate mortgage below the inflation rate for somebody else to fund that gold for me. But I can do it all day long with real estate. So that's, you know, primarily what I'm looking at is what they look at, which are interest rates.
The old U-Haul truck, man. It's so telling. The leading indicator of all indicators. But he teed you up, Robert. So maybe you could smash this one.
Well, I don't have all my stats sitting right in front of me,
Oh,
but yeah, definitely U-Hauls is something there. We watch also just the amount of inventory, because again, I know we've said it, but the when you've got that net migration behind you and there's just no inventory out there, both on the rental side and on the sales side. We've been hovering on that 3 weeks of inventory out there, which is absolutely crazy. It's the lowest that we've ever had in recorded history here in Cape Coral. Our rents have gone up 30% in year over year, just because the amount of people coming in and the demand that we have here has allowed everybody to really scale their rents up. And one of the other good things is that we're still fairly close to that median average. So it's not like our rental amounts have gotten too crazy. I think we still have a little ways to go, but some of those kind of trends, just seeing, you know, availability and inventory have been huge to watch for us.
Dustin,
Yeah.
what are you looking at, man?
So we're maybe even overkill with looking at the data all the time. You know, I think one thing and one reason why is because appraisers are always going to be lagging the market, right? They're looking at data from several months ago. So on the appraisal side, you know, when values are increasing, appraisals are coming in low because they're going off of sales from months ago. Well, when values are decreasing, appraisals are coming in high because they're going off values from several months ago. So I think it's very important to follow a few key, like, you know, like stats for your area, and look at a year ago what interest rates were, and look at a year ago what sales were as an indicator of where the trend is. Now, there's so many other like macro and microeconomic factors that you know come into the equation, but just look at single family sales down in the state of Florida in May year over year, 7% on single family, 14.5% on condos and townhomes. And the interest rate differential between May year over year is like 2.27 on conventional loans. So, you know, that means roughly, you know, if we're at, you know, rate locks on May would have been in March or April, some of them would have been in May. Now rates in conventional are into the sixes. So we're talking rate locks So we're looking at, July, and we probably look at an additional 6 to 7% sales price drop, just as a statewide. So there's going to be more of like Southeast Florida taking a bigger hit than some of these other markets we're going over. But looking at where rates were a year ago and sales data, and Florida Realtors is pretty good, unbiased, live data. If anybody just wants to Google, their reports. And because this is such a hot topic right now, there's a lot of like regular articles. They're coming out multiple times per month on where the market's at. And I think you can find really good data just staying up to date on that. Obviously, like bigger groups like Moody's, have larger forecasts, and these are super smart guys that are forecasting this stuff. But I think looking at where rates are for the month, year over year, and looking at where sales trending is going to be so much better than an appraisal, because an appraisal is going to be 4 months old on the data.
Man, let's unpack that for a second. I know we want to try to keep this to only a few more minutes. That was the instruction I was given here. But appraisals, and by the way, there are a number of bankers on the call. John, Dustin, and myself are all lenders. And Gary even mentioned it earlier. It's like, the financing is kind of difficult with these properties right now. So we're all dealing with the same, challenges. I'm not saying problems, because this is just the world we live in, but in terms of valuation, we're all dealing with the same problems. And that is that appraisals are always lagging. It's funny, I talk to my guys in the office and we have the conversation and saying, well, you know what? Appraisals are trained to look backwards. An entrepreneur is wired to look forward. You can see that there's no logic in how that relationship works. So we have to figure out a way as lenders and, kind of just business people to find that middle ground, that intersection. In an up market, appraisals are looking backwards and looking at old comps that were low. In a flat or down market, they're looking at comps that might actually be higher. So how are appraisals going to be valuing in the coming months? Let's just talk about, like, if the market flattens, not necessarily grows, but flattens, what are appraisers looking at, and is it going to give us bad valuations? This is important not only for us lenders, but the investors as well, because they seek financing for many of these loans and they really want to know what their property's worth. John, maybe starting with you.
Yeah, first, let me give you a little backdrop on what I've been seeing over the last 6 months or so. And we're doing a lot of purchase business for rental properties. It's a large portion of our total loan volume. And no surprise, we're seeing cut sales on the appraisals. So, the purchase prices that are going under contract are not being supported by the values. But I can tell you, the majority of my investors are just saying, I don't buy it, I don't care. I'm going to buy the property. I'm going to pay more because we're only going to lend on, the LTV is a lesser of purchase price or as is value. But investors continue to purchase and just come up with their own cash to do it. So they're not running away. They're not trying to say, I'm going to renegotiate sales price because my value came in low. They understand that the value is high and they're willing to pay that amount. So that trend has continued. The other thing that's happening is when we're talking financing rental properties, it's a DSCR model, debt service coverage ratio. So the property has to have the market rent in order to support the principal, interest, taxes, and insurance. And that is happening right now. So if, the market rents are coming in very strong because the data out there is showing strong market rents and the properties are cash flowing, even at these higher valuations and higher interest rates too. So remember, the debt service is affected by the higher interest rates, but they're still cash flowing. So I see that trend continuing.
What about you over there, Rob? What are you seeing in terms of the appraisal kind of problem, if that's what we're going to call it? Is it similar to what John said, or you think it's going to create some challenges down the road for financing and whatnot?
Yeah, I think that we've got a lot of buyers and sellers in the market here. And you know what, my advice to people as they've been getting ready to sell properties is whatever you think it's worth, add 50K to it. And I've been saying that, and they've been getting it. And That's starting to soften a little bit here right now, and I think that may continue on. But again, just like John was saying, I don't see the investors slowing down at all, because they're looking to put their money into hard assets in a high inflationary period. And even if they've got higher interest rates, they're saying to themselves, inflation over time is just going to eat away that debt. So it's just smart to hold on to that asset of that 30-year fixed mortgage. The other thing I'm finding is some people are actually saying, I'm going to go get a 7-year ARM and look to refinance later on. We've had some people say, I found lenders that gave me 4.5% for a loan, and they're going to hold it that way. So there's been, people are just rethinking things, how they're going to do it, what their strategies are. 7-year ARM with an idea of holding the asset for 6 years and then 1031 exchanging it later on isn't a bad way to go as well. So people are just having to think through it different ways. And then some people are just saying, you know what, I had $700, I was planning on $700 in terms of cash flow. The higher interest rates are going to take it down to 4, but it really doesn't matter, because over the next few years, my cash flow is just going to keep growing as inflation goes. So I think people are having to juggle around in their initial expectations, but when they look at it, they still realize that even though the expectations that they walked in with initially have changed, it's still a really good investment for them.
Awesome. So I was trying to chat and talk or listen at the same time. The question was, do all the lenders provide new construction financing? And the answer was yes. And I got to tell you, we spoke a lot about build to rent. We spoke a lot about cash flow versus appreciation. I think that's a great place to be right now, as compared to all the other alternatives. But last question, and we'll just go around the horn. Anything you think a new real estate investor should know or be considering right now in the state of Florida? Rob, start with you.
I think choose good areas, focus on cash flow, and I think investors are going to do really well. And like for me, when I say good areas, I'm pretty strong on in terms of Cape Coral. It's a master plan city. We do as well invest into Port Charlotte and some of the other areas around here, but it doesn't have that same master planned vision for the area. And I think over the long haul, both with your rents that you're going to get and also with your appreciation, sticking with the best areas that are reasonably affordable with cash flow.
Go around the horn, Dustin, if you don't mind.
Sure. Yeah. I mean, if you're set on being self-directed and doing your own deals, I think looking at alternative products like notes and things like that are a good idea. I would hire a builder. I have met Robert before, but I'm not throwing a layup to you. But I would absolutely hire a builder. That's a great way to go. You can rely on their expertise, their market knowledge, their everything, and I think that's a great way to get a builder, or get a property at below the median price per square foot and in the right area where you need to be. It's almost impossible if you look at markets like Ocala, Florida, to buy existing for as good of a price as you can buy brand new, including the renovation, and to get something at the same level for what you have to spend on CapEx and all that stuff. So hire a builder if you're set on doing something fully self-directed. If you're not fully set on doing something self-directed, then I think investing, with a mentor or somebody else that knows what they're doing in today's market is definitely advised.
What say you, John?
Yeah, I want to reiterate what I said earlier about investing outside the big MSAs right now. I think that's a real value play right now. So I think it's important to leave on that note. Don't go into the highest priced areas in the states of Florida. Most people know those areas that have run up. You're setting yourself up if there is a correction for a much larger personal correction if you buy in those markets. There's a lot of value out there outside the MSAs. And one other thing I tell all my investors, and this is nothing new to an experienced investor, but it would be new for newbies. And I do work with a lot of newbies as well. And that is, don't over improve in the area. I mean, if you're going to buy a house, even a rent ready property that's dated, when you go to fix it up, don't go overboard on it. I mean, I've seen so many mistakes where you end up with the most expensive house in the neighborhood, and that's not going to get you a return on your investment. Renters aren't going to want to rent in the nicest home in the area. And when you go to sell it, you're not going to get that top dollar because there's not enough comps to support it. So just something I tell all my newer investors.
Yeah, all great advice. And I mean, all I would add is,
guys, I didn't.
what I was gonna add is
Gary, I was going to say, I agree with all you.
All right. So I agree with the group, and my takeaway is that if a recession is coming, don't be afraid to have some liquidity sitting around. Right, there may be opportunities out there at the end. Don't feel like you have to dump money back into the markets. Right, like if you pulled it out, hold it out. Think about putting it into real estate, and don't be afraid of higher interest rate, locked in long-term fixed rate loans, because you can always refinance out when the interest rates do come down. And regardless, you are offsetting inflation with whatever the rates are. So I'm bullish, and certainly, again, don't overpay for land. You guys already said that.
Yeah, you guys are, I agree with all of you guys. I didn't think I was going to agree with Gary. So that's what I was going to preface this whole thing with. Kidding. I always agree with him. He's, like I said, so logical, like quite literally everything he said, but everything you guys said made all the sense in the world. John, I can't help but say, what I'm telling my clients is kind of the same thing. Not right in the city center anymore. Just outside of, it's going to be too expensive. But I'm also telling some of my clients to I think it was Dustin that said it. Partner up a little bit here. Don't fear a mentor or a partner or somebody that's been around the world a couple times. It's only going to help. Even a small real estate investing group, 2, 3, 4, 5 minds are better than one. So with all of that said, guys, I know we went a little bit over. I hope the people here got a lot of information. The 4 of you guys are pros. I really appreciate it. I personally got a lot. I can't wait till the next one, but I wanted to thank Think Realty and all of its members for listening to us talk. And I guess until next time.
Thanks, guys.
Bye, everyone.
Thanks,
Cheers.